Welcome to Under the Microscope. I am your host, Jenny Germano. Thank you, everyone, for joining today. Today's topic, we are going to be talking about cannabis mergers and acquisitions, different markets, and different opportunities. And before I dive in, I just want to give a little bit about my background. I got my start working in the cannabis industry in 2009 in Denver, Colorado, running vertically integrated cannabis operations. And in 2015, I founded my company, ICS Consulting, and I've been helping operators navigate the regulatory challenges across the United States for the last 11 years. And let's give a warm welcome to my next guest, Ellis Smith. And Ellis is the CEO and founder of Greensmith Consulting. Welcome, Ellis.
Thank you, Jenny, for having me. Glad to be here.
Yeah, I'm so excited to have you on. Why don't you go ahead and share about your background with everyone? I know you have a pretty long history about when you got into the cannabis industry and all the different things that you've been doing over seems more than a decade for sure.
Yeah, I am a steward of the plant. Been around it since the 90s. I watched my brother grow it through high school. Grew up in Mobile, Alabama, where they will throw away the key and lock you up for life if you get caught growing cannabis down there. Went to Auburn University, learned how to grow weed there versus getting a true education, and moved to Colorado in 2000 to finish a degree at Colorado State University, where I continued to grow cannabis then. That's why I really moved to Colorado, was one, to finish my degree, and two, to continue growing cannabis. During that time, I spent about 5 years in the specialty cut flower industry. It was exposed to large-scale greenhouse production and indoor production, environmental control production, and leaned on that experience for our indoor cannabis grows that we were constantly refining and building. And in about 2000, they passed medical cannabis in Colorado. And I got my first medical card, quickly realized I could grow my own plant, and then realized I could grow for all my friends.
Yeah.
Found some loopholes in the affirmative defense ruling behind our legislation that we were following, and we're able to grow for hundreds of patients at a time. And so at one point I had 5 houses I was growing in, from Boulder to Louisville to Fort Collins and everywhere in between. They changed the laws in 2008 or 9, I can't remember the year, saying, hey, if you want to grow in these areas, you need to stop. You need to align yourself with a dispensary and become vertical and get into a zoned space to run a real business, and shut down all the houses I was growing in, minus one, and moved everything into a warehouse in Denver and partnered with the dispensary in Boulder. I think that was 2009. And got some equity in that business. And that was my start to regulation, to working in the regulated space. I had some pretty bad business partners, sold out of that in 2012. It started American Cannabis Company and American Cannabis Consulting. And over the last, call it 14 years, we've designed and built about 3.5 million square foot of grow space all across the US, Canada. We've done stuff in India, South America, Europe. Built a brand on really going into competitive markets in the early days and writing applications when they were only giving out us a handful of select licenses, and really built a reputation and brand around successful application winnings. And behind that is where we got a lot of our experience designing and building cultivation facilities, because our clients were winning these licenses, and now we had to go and get them operational in these early days where we were all learning along the way. And then I've owned licenses from as far away as California to Mississippi to Oklahoma, multiple ones in Colorado as of recent, and have also sold some of these licenses over the last kind of decade as well. And so that kind of helped me with this conversation today on the M&A. But yeah, I'm a weed nerd. I may look like a freaking businessman, which I am. On the inside, I'm tie-dyed and dreadlocked. And I'm very grateful for this plant and what it has been able to provide for me, as cannabis is how I've made a living, illegally or legally. It has been a thumbprint on who I am and how I identify. And I'm very grateful for this plant and what it's done for me in many aspects, from health and wellness, as well as financially. Yeah.
I love it. And then Greensmith Consulting, you recently launched that about how long ago?
Yep. So I just sold American Cannabis Company and the assets along with it in December of 2025, and then have launched Greensmith Consulting here in 2026 and basically end of Q1. And yeah, off to a great start, working with some clients already in Mississippi and Nevada and a few other markets, and looking to expand into some stuff with the help of Jenny bringing me along with some of her cool projects. So I'm very grateful to be working with her as well, as we've done some work in the past. And so yeah, Greensmith is my new baby and getting this thing up and going.
I love it. Gosh, we met 2015. It was a long time ago.
Yes.
And it was funny. I was on one of your podcasts. I
Sure.
don't think you called it a podcast. I think you called it a webcast or something
Sure.
like that back in
Cool.
the day.
Yep.
There wasn't a lot of podcasting going on in the early days. They called it like webcasting. And so it's so funny to come full circle, and we ended up reconnecting again and working. I helped you on a project in Texas.
Thank you.
And
Thank you. She rocks.
yeah, I know it's been amazing. And now I'm bringing you on a lot of my projects going on. It's exciting to do some work with you globally and expanding, getting into the global market. So it's really been a lot of fun collaborating with you. And I really appreciate having you on because obviously you have
Thank you.
experience with mergers and acquisitions. I'm just here to learn and ask questions. So this is really not my expertise. And I'm grateful to have you here to share what you know.
Awesome. I'm excited to dive into this and to hopefully bring some just personal experience that I've gone through with this that I can share with our audience, and hopefully they can take some stuff to learn from this as well, and try to keep it very factual and try to keep my opinions to myself. Hopefully I don't get too opinionated, and yeah, I want to make sure I can bring value. So hopefully everybody can get something out of this. So thank you for the opportunity.
I've been very lucky. No one's really gone rogue, so I'm not too worried about it. Everyone has really been professional. Well, I'm going to start off why M&A matters to cannabis operators. And, we're seeing a lot of this consolidation in cannabis right now. What is driving the M&A activity that we're seeing across the industry?
I think a lot of things, regulatory change is driving a lot of M&A. I think consolidation is happening due to price compression as well. And so there's definitely some external factors that are causing operators and owners to look at exit strategies. We're in a unique political environment right now where we are looking at rescheduling the plant. That's going to equate to major change in all aspects of the business, more fees, more compliant, more regulatory framework. And some folks may just be like, I'm done. It's time to exit, time to get the check written to me so I can sail away and watch the sunset and the beach. I've done my time and I don't want to take the next step into this next compliance change because it's going to be crazy.
The next era of
And
change.
this is the next era. We're now becoming a legitimate industry. And so some folks may not want to take that next step and change. And so they may want to be acquired from that perspective. I think also too, there's some mega players out there that are making moves and have proven to their investors behind them and their shareholders that they have a big appetite and they want to control the market and be the tip of the spear in 10, 15, 20 states and have this large footprint so that maybe as they're acquiring smaller businesses to build under their umbrella, they also may have their own strategy of an M&A in the next 2 to 5 years as they're gobbling up all these assets so that they can get someone write them a check. Maybe it's big pharma because of this rescheduling. And so I think it's just the nature of business in America. I think just M&A is just always going to be there no matter what industry you're in. And I think we just have some external factors that are causing folks to look at it from different lenses. And so I think it's really dependent per situation and what. And so I think you see it all. Like I can tell you right for me, I sold assets that I had in Colorado Springs, 3 dispensaries, cultivation facility. I was tired of driving down. The traffic was killing me, you guys. It should have been an hour door to door each way, would turn into an hour and a half, 2 hours each way. And that's taxing. It's not the quality of life I wanted.
Yeah.
I wish I would have had those businesses here in Denver where I'm based. It would have been a totally different story. And that was what drove me down. One of the many reasons that I sold. And so it's all situational, honestly.
How different is cannabis M&A from traditional business acquisition? Why should an operator who has no plans to sell care about understanding M&A?
What's goofy about cannabis and other industries is you'll see businesses that'll be in operation for 5 years and have lost money every single year, have not had a single profit made, and they'll be able to sell the business for one-time revenue. You don't really see that in other industries just because the nature of the licensing, the license has a value to it because it may be limited in a certain market. So someone can come in and now make it profitable. But right out of the gate, that's the first thing is just we're very non-traditional as far as how businesses function. And there's a value to these licenses and these operations, unlike a copy machine business or a FedEx delivery business. Cannabis has a little different shtick to it. And so I think that's adding to it.
Also wanted to ask, what opportunities, risk, or changes could M&A create for these operators?
I hope I'm answering the question correct. Basically, if they're not thinking about M&A,
Like highlight, I guess, some of the opportunities that they might not know are there.
yeah, the ability to exit, the ability to have someone write you a check for the value of the work you put in over your business. I think that's important for all business owners to always have that as a backup plan. At some point, maybe your wife gets sick. Maybe little Johnny wants to move to a different state because he's now a baseball star and you want to put him in the best education and school system to foster the
Yeah.
baseball star. So you're like, I got to get rid of these businesses. And so what do you do? And I think it's good for these operators to always just have that in the back of the mind and try to run the business with a systems approach so that when they do go to
Agree.
sell, they have good processes that are scalable. And that also too, I call it the fishing trip syndrome. People talk about this all the time is can you leave your business for 7 days and be on a boat away from your staff, no cell phone, no emails, no communication, and your business run without you?
We were also talking about markets, and I want to dive into emerging markets versus mature. So let's start with emerging. What does M&A look like in a cannabis market that's 5 years old or younger? But obviously, M&A happens in mature markets and these new markets.
In these emerging markets, it's very sexy because the market is still fresh. It's new. We haven't seen price compression really hit yet. There's still a ton of growth happening. And this is where we've seen where licenses, the piece of paper alone in Florida was going for $60 million in the first couple of years of these businesses, just a piece of paper. And so I knew groups, and I actually worked with groups who specifically went out in all markets across the US in limited markets with limited licensing, but a piece of paper was worth its weight in gold because you don't have a lot of competition. People would just go in, write applications with the goal of selling it immediately. Go spend $250,000, hire all the technical writers, submit the application, and go sell the license for $5 million. And I saw people made millions doing that alone. And then states got smart to it and started saying, all right, we got to put some standards in here. You got to hold on to it for XYZ time. But I think it's really sexy up front because price compression hasn't happened. The licenses are still in this growth trajectory in a new market. There's a ton of hype in the news and just the industry alone and the public stance on it and the consumer standpoint. And yeah, a limited license, there's just more upside to sell versus a mature market where its price compressions happen with the product. A lot of states have allowed more operators than they should have had come in. And so now you've got a lot more competition. And now the valuation behind your business is going to be significantly lower. And so there's definitely some pros and cons behind the both.
It was very interesting in the early days because now they do have that rule in most states. Whenever you're doing an application, you're not allowed to sell the license. Like you have to get operational. In some places, they even say you have to be operational from 1 year up to 5 years. Every state is different. I mean, they hit the kibosh on that pretty quickly when they realized people were being predatory. I mean, offering millions of dollars for these licenses, but now most states, they do require that you have to get open and pass inspections. When we get into the micro business applications, they require that you have to be 51% owner. The original person has to still be part of the business, 51%. So they obviously caught on.
Of course, I think it got abused. The whole social equity program really was supposed to empower these folks that were victims of the war on drugs. And then you got these big, gigantic MSOs preying on these guys, using them as a straw man, giving them pennies on the dollar. They're going to go in there and make a $50-100 million company in these new markets. And these people basically are just on the sidelines going, yay, I got a little bit of pocket change, way to go. And so it got abusive. I think it got abusive for sure.
It happened in a lot of states. It really did. And let's talk about the mature market. We're dealing with declining prices, oversupply, and intense competition. Colorado's really saturated. We've got other markets like Oregon and Washington.
Yep.
But Michigan has definitely become oversaturated, and I would consider Michigan a mature market now. What are these M&As looking like there? Because they're definitely a little bit different.
It's a game of margin at this point. These businesses have historical records. They can now look at financials and really truly understand the business performance. And that's the difference between startups, because most of these startups in the new era, they don't have their books in order for the first 3 years because they're scrambling trying to figure shit out. So they don't even know their true financial hygiene. With a mature market, it's now looking at financials and really truly understanding the business and what it looks like from a management standpoint. Is it a people problem? Is it a plant problem? It's always people problems. As a consultant, I'm hired to fix plants. It's people. It's not the plant problem. It's the people doing the wrong SOP. And this is where these existing markets, older markets, these guys, it's now about systems and processes. How well are their financials? Are they profitable? This is what's going to be attractive to somebody coming in to buy them, is someone that's organized, someone that can tell you their cost of goods sold, what it costs to grow a gram of cannabis, what their labor costs are. All of these things, this is the metrics from a mature market that you should know if you want to get into selling your business, because this is what a sophisticated buyer, and these guys coming in and buying businesses, they're highly sophisticated, are going to be looking at. They have to look at this.
No, that's really good. Colorado is a great example of what's happening in a mature market right now. What can operators in other states learn from what's happening here? We're always what to do or not to do in Colorado.
I think Colorado, we opened the floodgates and it was a free for all in every town across the state as far as licensing goes. And so there's just a ton of competition. A lot of the other states didn't necessarily have that wave of operators coming in. So it benefits them for not having so much competition. And I think what they can learn from us is, yes, it's price compression. It's a race to the bottom. I think at one point we peaked at over $2 billion of revenue in a year or two as an overall industry from medical and rec. I think now we're down to almost half of that. Just goes to show you tourism dollars are not coming in. Other markets around us have opened up, relieving that pressure that we were selling everything to. And so I think it's a game of systems and processes and getting your cost of goods dialed, understanding what it costs you to grow the plant, what your customer acquisition cost is from a dispensary standpoint. All of these metrics that traditional businesses are running off of, you have to be doing too at this point. You have to.
I think two other things that people can take out of Colorado is, one, how to survive the price compression, how to survive the race to the bottom, and how not to participate in the race to the bottom. Because there are a lot of people in Colorado that are successful. I know people that still are getting $1,600 to $1,800 a pound, or other people are getting $400 a pound. And I know people that have never lowered their prices since 2019, even earlier than that. So I think there's that piece that you can learn from Colorado about the people that have been able to navigate the price compression game and how they're dealing with that. And then also, I think other states can learn from Colorado, really thinking about an open and free market versus a capped market. Because I look at Missouri as a really good example of a not open and free market, which it is capped. And their price per pound is, I think, around $2,200 to $2,300 a pound still in that market in 2026.
Awesome. Very sustainable. Holy shit.
And they've kept it up there. And they're a good example versus the capped versus the open and free market for where we're at, open and free market. And two, not every town in Colorado was allowing cannabis
No,
licensing. Colorado Springs just opened up. I'm sure that probably helped with the sale because
it
you can
did.
do adult use, but you couldn't do adult use in Colorado Springs till just recently, 2025.
Yeah, that's why I bought down there. Literally, we bought, and within a few months, they were having the vote to basically approve rec, and it didn't pass for literally 5 years almost from the time
Long
I bought
time.
down there. So
Yeah.
100%.
Yeah. And so we had a lot of towns on the Eastern Plains and all over certain parts of Colorado that said no to adult use cannabis, not medical, but to adult use. And a lot of them have been coming around these last 2 to 3 years and saying, okay, we want to allow licensing. Some of them aren't even doing grows or manufacturing. They're only allowing 3 dispensaries or 2 dispensaries or 4 in their small towns just to get some tax revenue. So it's been very interesting to watch Colorado evolve. And I think if you can survive the bottom falling out
Sure.
state in the cannabis industry, I think you're going to fare pretty well. I think because I see people right now that are thriving in Colorado
Yeah.
and in Oregon and in Washington, and they have survived the bottom falling out. So
I think because they have a business acumen and they understand the right key performance indicators, the KPIs that they should be tracking from a daily, weekly, monthly, and yearly perspective.
yeah,
And that's what is attractive for M&A. Someone who's got their shit together, someone who can withstand the test of time. Look at what's happening in Colorado right now. What grow is being shut down? The large one,
native roots.
140 people. That's insane.
Yeah.
And so how could they prevent that? Right. And maybe it just wasn't necessary because the demand is not where it needed to be. They acquired all these other brands and they realized that with all the retail stores they have, they don't need that grow. And instead of either selling that grow and making money, they probably shut it down to reduce competition in the market. That's just my speculation. I don't want to give you an opinion, but who knows? Either way, but that happens. It's the reality.
So too, I think at one point, when all these companies bought all these licenses in Colorado and had 23 dispensaries everywhere and 15 to 20 grows all over the state, you can't operate like that. You have to be lean now. If you want to survive and succeed, do you really need 10 grows in Colorado when the market's flooded?
No.
I think people might want to get rid of the dead weight. And I understand what everyone did. It was hot, like 2019. I mean, it was grows everywhere. Everyone had a lot of grows, a lot of dispensaries. If you really do have 20 dispensaries, what's that going to get you? There's got to be some that are not doing well. You know,
Absolutely.
and
Well,
yeah,
sure.
why wouldn't you just keep your best selling dispensaries and your best grow that produces the best amount of product and yields? And, why do you need that many grows? And so I would think maybe they shut it down for that, but maybe you're right. Maybe it got shut down for competition in the market too. I mean, look, there's pump and dump weed.
Yeah.
Every market, all across the United States, somebody builds a grow that does pump and dumping, and their goal is to undercut. And what happens is I feel like they end up outpricing themselves in the market. Or you can be craft cannabis and put out quality cannabis and not bend the knee, basically, and not bend the knee to the race to the bottom and, stick to your own pathway. And I think you can succeed.
Quality is the name of the game, as we all know. That's what makes these businesses sustainable. On the smaller operators, figure out your processes, get really good at them, figure out your strain portfolio, adjust where you need to with your strains as the market evolves. And let the Walmart weed and the Budweiser weed get grown out there. There's a market for people who want cheap grown weed because can't afford to buy maybe the more expensive stuff. There's a market for everybody. But there is a sustainable pathway if done the right way.
I agree. I know we talked a little bit about this, but if I'm launching a cannabis business today, and I think I may eventually sell it, what should I be doing differently from day one?
Sure. And so I think it's a systems approach to really refine every aspect of the business from how you're doing things so that you can do that fishing trip analogy concept.
Yeah.
I think that is from day one what you should be doing. You should really have very well thought out 3 and 5 year plan financially as far as benchmarks and key performance indicators, KPIs that you should be tracking yearly to get to that, whatever key performance indicators you set to say, now I'm ready to go and start to see if I can sell my business, whether it's a certain amount of growth around going from 1 retail store to 5 retail stores. Maybe it's a certain amount of revenue coming in, maybe a certain amount of profit that comes in. All these things can be utilized as a way to say, these are my benchmarks now to go find someone to buy me because I hit certain benchmarks that made sense. And yeah, I think just as an owner and operator, you should always be looking at the finish line as a way to potentially exit. You never want to do that when you start a business because you're like, I'm starting a business, I don't want to exit. But all partnerships and contracts have exit strategies, so you should have the same thing for your business.
Interesting. What's fascinating, and I'm sure you've heard this, and maybe people have heard it in other mature states, but I've run into operators in Colorado saying they wish they had sold in 2019 when the market was hot. And people, they kept holding on. Maybe they thought there's going to be more. I'm like, what do you think about that? Because I do meet people going, oh, they missed the boat. Oh my God, I missed the boat. Now I'm screwed. My business is not anything what it was worth in 2019. I should have sold, and now it's not worth anything. It's like
I have that same remorse that I wish I would have sold earlier because of that reason. Thinking that give me a couple more years, I'm going to increase revenue by X, Y, and Z. And I've got a good friend of mine who's a roofing company, and he's like, man, I can get $17 million for my business right now, but I'm going to hold on to it for this couple of years and run it up so I can get 30 million. I'm like, if someone's ready to cut you a check for $17 million, you're a fool to not take it and run. Don't you dare wait another year or two for your business to hopefully go up. What happens if it goes down? That 17 million goes to 3 or 4 or 5 million. Now it's a game of what ifs. I've been there. I know what that's like. It's a horrible feeling and a horrible way to be.
Talk to people, like people that do audits for, and they're like, man, I wish I would have sold it.
Good, I would have.
And now they're stuck with this thing they don't even want anymore. And then their debt, they're upside down on the business. And not only that, a lot of these grows and manufacturers, they got into these crazy lease agreements in the early days. And now they're paying these huge prices. And when new operators come into our market, they know, okay, I don't want to end up in those crazy lease agreements. And so they're already beating out their competition because they have better lease agreements. They have better landlords. They're not upside down the business. They're like, oh, I just want 5,000 square feet for my grow. I'm okay with the craft category. I don't need to be pumped. And you've got other people with these huge facilities that have so much overhead cost with them. And I see that happening in our market too.
Yeah, like even a good example in Mississippi, there's some big players, MSOs, that came in, borrowed money very expensively, and they've shut down. They got a big footprint with stores, mega facilities. They couldn't pay their notes, couldn't pay their investments back. And that was a strong market where wholesale cannabis was going for $2,500 a pound. And these guys had retail stores, so they're doubling that. They're keystoning all that. So they imagine they're getting $5,000 a pound. They overproduced. They saturated the market. They created a race at the bottom. And so you got to be careful how these operators come into markets, because they can definitely cause some damage by oversupply and creating a glut, and then causing a lot of things that downstream affect everybody.
Yeah. And what's the price per pound in Mississippi right now?
Some people are getting anywhere from, I think if you're growing crap, you're probably getting $500, $1,000 a pound. If you're growing quality, you're getting $2,000, $2,500 a pound still.
Oh, that's interesting. Yeah, because they have around close to, I think I last checked, 191 dispensaries in Mississippi.
Not everybody can grow good weed. There's some really good growers and some that consistently can't continue to grow it. That's the key, consistently.
So what makes a cannabis business attractive when a buyer first looks at a cannabis company? What are the biggest things that they're actually evaluating?
Yeah, so I think the first thing is, what's the asset? How attractive is the asset, right? Is it a dispensary that's on a location that is just traffic galore and the most ideal location, like any retail store location. This is the cultivation facility that was built out to a T. It has all the bells and whistles and technology that you would want in a modern day cultivation facility. And so I think first and foremost, they're going to want to know what is for sale, right? What's the asset? And what does that look like from just the ability to correlate that to now the next thing being the financials? I got this beautiful retail space that maybe has high volume. I've got this beautiful cultivation facility that didn't spare any expense and it's built to a T with all the technology. Now you look at the financials and the financials are proving to you, wow, they run lean, they got a high profit margin, and it looks like the business on paper is making sense based off of this location that we knew was good from our own research that we did, on top of the walking through the cultivation facility and seeing all the technology and the health of the plants. Those things correlate. So that's going to be your first two things. You're going to want to look at just those two things right out of the gates. That's going to tell you how good or bad is the business functioning. Then you want to start looking at people. You may want to fire every damn person in there and bring in a whole new team. I've seen it happen before. Or you keep everybody in there and you continue to pay them as they do and follow the same pathway of their performance and everything before. And you're looking at people next. And that's about where I would draw the line, is just those three areas, so that if you were to acquire the business, you start to formulate a strategy of, okay, how do I improve people through the door on this location that's very high volume? How do we take us growing 80 grams a square foot at 70 cents a gram to 90 grams per square foot at 60 cents a gram? These are the things that an owner operator is going to start to look at with his team to say, all right, where can we make improvements? Where can we lean this up even more? And that cascades down to the team on site. Can these people pull this off? Can they follow directions? Or do we got to bring in our own people?
Yeah.
So.
No, that's really good. How important are operational systems, SOPs, compliance records, licensing, taxes, and regulatory history when determining whether a business is attractive?
This is what will really separate operators from getting acquired from others, especially in a competitive market like Colorado. We'll say, for instance, let's say you're a little 5,000 square foot boutique cultivation facility. You just wholesale. And let's say you're doing $2.5 million a year in revenue. And let's say you have a 30% EBITDA or profit margin. Okay. So EBITDA is basically your earnings before you calculate in your interest and your taxes and the depreciation and the amortizations. This is just the way that businesses are basically valued when you start looking at financials from an accountant and really looking at the details of how the business has functioned and made money. From an EBITDA standpoint, you're going to want to understand how profitable is that business. And if that business is doing, call it 30% profit margin, and they're a little small boutique grow, and they're doing $2.5 million a year, and 30% of that will be, call it, I can't do math right now, so call it $750,000, $800,000, we'll call it a profit margin that the $2.5 million business is making. That's a huge profit margin. That's great. Versus that same investor maybe looking at a 20,000 square foot facility that's doing $10 million in gross revenue. It only has, call it, a 5% EBITDA. And then you're going to look at it and wonder why. What's going on here? The 20,000 square foot one may not have good systems and processes and has compliance dings on the license and things like this. And when you start to look at both of these and say, man, I like 20,000 square foot. That's big. It's huge, big opportunity. Or does the 5,000 square foot one make sense to buy? You don't really have to change anything. You just come in and continue operations. Or do you take the other one that's bigger that will require a lot of hands-on work?
Yeah.
Your team to get in there and roll their sleeves up to get it to where you need it to be. And so this is where the game starts to really understood that a lot of time processes and standards and SOPs are what really will drive an investor to buy you or not, because it just really shows that you have a scalable business. If they want to buy it and scale it, they want systems, they want processes. That's what I want as an owner and operator. I want systems and processes.
Clean and lean, man.
Better believe it. That's it.
And
Or
lean.
in my lens, sometimes it's a shithole. I need to put 100 grand into it. I got to fire the whole staff in there, but I
Clean
can,
it up.
but I can clean it up and I can do the bar rescue concept. Like these guys will come in and overtake bars that are failing, and then you turn them around and
The fixer-upper.
fixer-upper. And so you've got different strokes for different folks as they look at the M&A game and how they play the space. I play on both sides because I design and build grows. I can fix these things pretty quickly and easily when I identify the problems from from a systems aspect of mechanical systems and whatnot. So yeah, it just depends on what your appetite is and what your background is. A lot of these guys are just money guys. They don't have any interest in having to turn a business around. They want to functioning, making money, and that's it.
Yeah. I will say that we do appreciate Alabama math on this podcast.
Absolutely. We're proud of my Alabama math for sure.
Alabama math. We'll take it.
Well, look, always 3, right?
Yes. Next, we're going to talk about valuation and what the business is actually worth. And let's talk about who ultimately determines what a cannabis business is worth, the seller, the buyer, or an independent valuation. Like, how does that work?
Usually we've got independent valuation coming in. This is where, and a lot of people don't know this, but in order to sell cannabis licenses, you have to have a broker dealer license or real estate license to be able to sell these things. Else you're breaking the, whatever it is, the SEC Securities Exchange Act of 1946 or whatever. And so you can't do that. And so first and foremost, people don't go out there and play in that space. Now, you can get paid a consulting fee for doing this kind of stuff and helping. And this is some of the stuff that Jenny and I do. What was the question again? I got sidetracked there.
Who ultimately determines?
Right. So usually these brokers, these real estate people, they're the ones going to put a valuation on it. First and foremost, they're going to look at what's the piece of paper worth? What's the license worth? Is it in a limited market, or is it in a state where you can go and apply for one for $10 and get operational again? That's going to dictate first and foremost, is that piece of paper worth its weight in gold because there's limited one? Second, is there assets tied to the business that the business owns that will transfer during the acquisition? From a cultivation facility standpoint, there's a bunch of equipment that was purchased and bought and put into the facility. That stuff has value and can get put onto the valuation. If you own the building, those can get put into the valuations. Same with dispensaries and extraction. They're going to look at the equipment inside of them. They're going to tell you how much the equipment has depreciated. Those depreciation numbers will be part of this as well from all equipment that's been put in. And then
it depreciates the minute it comes out of the box, doesn't it?
You better believe about 50%. Yeah, automatically. So it sucks. You don't get much out of it. And then finally, if you are operational and you have financials, then we're going to dive into the financials and go back to the EBITDA. And what is your yearly profit margin on the business? And there's kind of a way to now with a formula to put those variables together to come up with a number that someone hopefully is willing to pay. Because at the end of the day, the value on is based on what someone's willing to pay. You can ask, like right now, what we got our friend in Alabama or in Mississippi that wants to sell her for $1.1 million or something crazy.
Actually, I think 1.2 million.
$1.2 million. And honestly, there's no way she's going to get that for it. But I think she's probably got less than a couple $100,000 into it. And so once again, I think it's like any asset, anything you put out there with the right pricing, it'll move. With the wrong pricing, you're not going to move at all.
Yeah.
And so, yeah, I think those are the things I'd be looking at.
What I find interesting too is I feel like a lot of times the person who owns the business, they obviously want a higher valuation.
Always.
And so do you ever see businesses getting overvaluated?
Of course.
And then and under?
Of course. Yeah,
that's the nature.
Yeah, because their expectation is to negotiate, right? That's the negotiation. Start high, give yourself plenty of room to get down to a number you can live with.
Always start high so you can go down.
That's business.
Don't start low and then you're like,
you go up. You're screwed.
Yourself.
That's it. And you never know what you're going to get unless you ask for it. And if you don't ask for it, then the answer is going to be no.
What if owning the property? I think it's a good thing to own the property.
Sure. 100%. Absolutely. And a lot of these acquisitions will come with those assets as well. And that gets more complicated. But yeah, a lot of these guys have purchased buildings and do own them. And some of them may not sell the building with the acquisition. They'll sell the licenses and all the plans and everything with it and play landlord. And that was one of the things I was looking to do in Colorado Springs with one of my dispensaries was I was going to buy one of those buildings and then basically sell it and then be a landlord.
Yeah.
So
it could be an opportunity if you do own the building and you decide that you sell the license, even if, let's say, somebody moved, another business can move in there, another commercial business in there and use your property and you could still be the landlord, or you sell the license and they want to use the building and you could be the landlord, or you could just sell the property and make money in the whole deal with the property as a package. I want to talk about due diligence, and this is where I think the real work happens. Walk us through what happens once a buyer becomes serious about acquiring a cannabis company. What happens after that letter of intent is signed?
Yeah, so this is where the rubber meets the road from an acquisition standpoint, where letter of intent is sent out. The LOI is to basically tell the owner, hey, pull it off the market. I'm ready to get down to business. Here's the terms that we're looking at. And it's usually, I like them to be on one page. LOI should be simple, freaking easy, basic, simple. This is very simple. Outlines the deal. Once that's done, now it is, once again, coming in, looking at the business and understanding what infrastructure, if any, needs to be upgraded. Why I need to fix anything within this business if I'm going to purchase it? Is there air conditioners I need to get for the grow? Is there new POS systems for the dispensary? What are those things need to happen? Second, the financial hygiene is the number one thing that's going to tell the story. That's where you're going to find all the skeletons in the closet. This is where you're really going to look under the hood to truly understand how the business has been functioning. And to kind of add context to that, a lot of cannabis businesses don't have good financial hygiene. Most of them haven't paid taxes for a couple of years, times up to 2 and 3 and 4 years. I see this a ton. And they have no clue what's happening in their business. I was a public company doing acquisitions. I couldn't buy businesses that were so basically backdated with their taxes, because as a public company, as soon as I acquire this business and make it known to the public, I have literally, I think it's 60 days to provide audited financials, meaning those books have got to be in order, meaning the taxes have had to been paid the last couple of years. And I am not floundering to try to put together legit financials that can be reviewed and can be audited and can be approved by the SEC.
Yeah.
Well, this is what was really challenging for me as a company is I'd look at 100 deals and literally 2% of them would qualify for us to look at what could be an audited financials, because people are so disorganized. And so that was a reality for us. It was crazy to see that no one knew their numbers. As a public company, I file every quarter, every 3 months. You got to know your numbers. I'm getting closed out books within the first week of the following month for the previous month, every month. You have to know what's happening. You have to know what's going on.
People who are buying your stock, they have to be on the website and listed. People have to be able to go and review your numbers. I actually know CPAs that are going, all the cannabis companies that are listing on the stock exchange, they're going and looking up all their tax filings, everything that they're listing on their websites, because they're just so curious about what these big MSOs are doing right now. It's a way to gain access. So next I want to talk about deal structure and what does the seller actually get when a cannabis business is acquired. How are these deals typically structured? Are we talking cash, stock, equity, or is it a combination of everything?
Man, you'll see it all. Nobody wants to give up cash. Everybody wants to give up equity or shares or stock or clean up some past debt from the company. All of these things are leveraged. And sometimes the seller has no choice because they need to get out from underneath some debt, or they believe strongly the company acquiring them is going to take the company public and run the shares up to X, Y, and Z valuation, and they can cash in stock. And I've seen it all. I've done cash only transactions. I've done cash and stock transactions. I've clear debt. I've had debt clear for me on some transactions. I've done it all. I've seen it all. People get creative. The less cash exchanges hands, the better in the purchaser's perspective. And a lot of deals right now are done on stock. Look at what Vireo is going around doing. They're doing all stock transactions.
Oh, yeah.
That's what Medicine Man Technology, when they went public, they were going around doing acquisitions, and it was all stock transactions. And so people were banking on that stock to double and triple in value and go up. And it's high risk, high reward.
It is.
And when the reward comes, praise hallelujah, 𝗘𝗽𝗶𝘀𝗁 because I am not kidding. It's a glorious day in the world when that happens. And I mean it.
Oh, man. I want to talk next why M&A deals fail. We've talked about what makes a deal attractive. What are the biggest reasons cannabis M&A transactions, why they fall apart?
Transparency. I tell you that right out of the gate. First word came to mind. Because as I mentioned before, I look at 100 deals, one or two of the 100 deals can actually tell me the history of their business and tell me how much money they made or how much money they lost. And so a lot of companies aren't in position from a financial hygiene standpoint to be acquired. They just don't have their books in line yet. Once they do that, it is so easy. So having their taxes paid on time is going to be the big one. But if they're waiting and filing extensions to do that kind of stuff, get on a normal pace, get on a normal business pace of how you should be handling your financials, because when the time comes, and then who knows what the reason may be, as I mentioned earlier, there's all kinds of things from moving, having kids, getting hit by a car, who knows? You want to have your financial hygiene in check so that the time comes, you can move pretty quickly. That also stands the test of time of that fishing trip or that ski trip or whatever it is you're into, that if you got tight books, you can be anywhere in the world. And we got these pretty snazzy little phones here that are damn computers that'll tell you anything and everything from remote satellites globally.
Yeah.
And if you're organized and have your SHIT together, it'll be so much easier for you to, one, just run a smart business, and two, if you ever want to get acquired, it's easy. So
How much can the existing management team, employees, and company culture affect a transaction? Can the people side actually kill the deal?
no, because if you're acquiring the business, you can come in there and fire every damn one of these people. Most people don't want to do that. Some people may leave just because of the changing of the guards. We expect that sometimes, right? Some of the executive team may leave because they're used to working with the other executive team that own the company. But you'll know quickly where the problems are within the company during your due diligence, whether it's people, plants, financial, whatever. You'll know
Processes.
quickly. Yeah, all that stuff they'll quickly identify. And if it is the people, you'll get a plan of action. If the business makes sense to purchase at the price that it's valued at and the margin is there for you to make money on,
Yeah.
that business in general, that's 101. You'll handle the operations.
The 3 Ps. There's an entrepreneur out there who I really like a lot, which is Marcus Lemonis. And he's like a serial entrepreneur. And one of the businesses he owns is Camping World. He used to have a show a long time ago.
Is awesome. I love that guy.
Yeah, he used to
Canadian,
come
right?
in and it was like bar rescue. He'd
Yeah.
come in and he
Yeah.
would pick a business and he would rescue them.
He was the man.
And I was just starting my business in 2015. So I was obsessed with watching his shows and I was just trying to learn about entrepreneurship businesses. And he always talked about the 3 Ps: people, processes, and production. And production is your product or service, whatever it is that you're selling. And if you don't have those 3 down, you're not going to have a good business. And if you don't know your numbers and if you don't take care of your employees, he used to nail people all the time. They would come in and the whole employee situation was a mess. They weren't getting treated well and just everything. All 3 areas of the Ps were failing. And I think it's important to think about those 3 Ps.
I'll add in, so there's another acronym for 3 Ps as well to build onto that. And this is coming from my tree hugging hippie background, my granola yogurt eating ass, where it's basically where
I don't have a bleeper on here. I don't have a beep.
I follow the business mindset of a triple bottom line, and that's basically putting people first, the planet second, and then profits last. And that's just, if you guys know who 𝗘𝗳𝗀𝗍 𝗂𝗧 is from Patagonia, he really led by example with Patagonia, his brand, and with that mindset. And so the triple bottom line, I'm a huge fan of as well. But the 3 Ps you're talking about, that's the foundation that from an operation standpoint, if you don't have those things organized, you're done. You are done.
Yeah, I really was drawn to him because I loved how important he made employees. And that's really important to me as somebody who was a former employee in this industry. And I think that mindset is really important to make sure to put your employees first. And a lot of the businesses he would go in and rescue, they were like, the customers first, the customers first. And he kept saying, no, they're not. The employees are first. And people are like, what are you talking about? And he's, hello, if your employees are happy, your customers are happy. That's how it works.
That's it.
And so I love that mindset that he shared, and it's always stuck with me. We're going to do some closing thoughts here. What is the biggest misconception that you think cannabis operators have about selling their business?
That their baby, they spent the last 4 to 10
Their
years
baby.
that they have been living and breathing and shaping their day-to-day life for however how long may not be worth what they think it is worth. And sometimes you have to have a third party tell you that your baby's ugly, and it may not be as pretty as they think it is. And so I think it can be a humbling experience to come to that realization that maybe it's not worth what maybe they thought it was worth. So I think that's something for sure for these people to really pay attention to. Now, if you know your financials and your hygiene is really good financially, and you know your business, and you understand business in general and how they're evaluated, you should have a pretty clear understanding of where your business is going to land. Sometimes it's off this EBITDA number we keep talking about. Let's say your EBITDA is $250,000 a year. Sometimes you can get a multiple of up to 3 to 4 to 5 times of that EBITDA number. And so that's just something to kind of give you a foundation to work from, we'll say.
Yeah, the whole, it's my baby. I think about, they kind of want the emotional attachment, the sweat and tears, money aspect of it too.
Exactly.
And that just adds another, like, I don't know, hundreds of $1,000s to it, because I think a lot of times people attach, what about all the crying into my pillow, or all the tears and all the sweat and all the hard work and the emotional attachment of growing it from a seed to a business. And I think a lot of people want to put a value on it too.
Yeah, I think so for sure. But at the end of the day, it's only worth what someone's willing to pay. And you can't put a dollar amount on emotion. We have to pull that out of it, even though you want that part of the equation. Unfortunately, we have to remove that out of there. You see a lot of people who sell too late when they're already losing money. They're in the red. And let's say they only get $2 million for their business, and that pays all their debt. And you know what? Maybe they walk away with only $100,000 and they paid $2 million in debt. And you know what? They walked away with only owing $100,000. That's not bad if they racked up that much debt, if they have issues or problems. And so there's so many things that you can take away from this depending on your situation.
You could lose so much more too.
Good, 100%. You may not even sell it. You may just lose it all.
Yeah. And they do lose it all. They do lose it all. If anyone has the chance, look up Ice-T had a business in California. There's a couple videos out there where he talks about how he lost it all. He was having to pay rent like $30,000 a day, and they went too big out of the gate, and they were trying to do too much right away, and they should have started small and done baby steps. And the rent was more than what they were bringing in, and they had a dispensary, and he was like, I just had to shut the whole thing down. He was taking money out of his personal account to try to rent. And It's a really interesting story. I'm sure you guys can find stuff on YouTube if you look it up. But when Ice-T involved, I think it was obviously
Yeah.
California cannabis industry that he invested in. So, and I was like, man, that is the truth. He put a video out there and I shared it. And I'm like, he is telling some straight truth here.
Yeah,
So,
it's true. Sometimes you line yourself with the wrong partners. I've worked with
yeah.
multiple hip hop artists myself, and I've heard them tell me their experiences with trying to launch brands with the wrong partners. And it's just not easy. This is business. Just because we sold weed in baggies before it was legal does not mean now following regulation and running a legitimate business is the same. It's a
Yeah,
whole
I think
nother thing.
sometimes the capitalism and the money and it being a business, the capitalistic part of it, somehow people try to mix it with the culture, and that two different things, right? Cannabis culture versus running a business, you know, a profitable business,
Right.
running it into the ground.
That's it.
You can have a great cannabis culture, but you still can run it like a business.
Absolutely, you can. For sure, you can. And there's a lot of great guys doing it that come from the legacy market that still have been true to their roots, but run a legitimate legal business, but their culture is just something you want to be a part of. They're
Yeah.
infectious. They're awesome to be around. They run successful businesses and they're profitable, but they run a tight ship. They run this shit like a football team. The standards are high and the expectations are high and they're set. I love how you say that because we don't want the culture to be lost. You and I are aging and we may not look the culture, but we are the culture. Like,
I was buying weed in the 80s. I was too young in the 70s, but I was just a baby. But
totally.
like the 80s, I was the generation buying, smoking cannabis.
Mexican dirtweed. Most of these kids don't even know
Brick,
about
it was,
Mexican dirtweed. Brickweed.
oh man, brickweed. Yeah, brickweed. There was no kind bud, not in Ohio where I grew up.
KB.
So
KB. Remember, yeah, get that KB, man.
I didn't know what kind bud was until I moved to Colorado, and
Yep.
everyone's, oh, you want to smoke some kind bud? And I'm like, whoa, this is amazing after smoking brickweed my whole
Totally.
life in the
Totally.
Midwest.
Yeah.
So, or ditchweed in some places. One of my friends from Oklahoma, they used to call it ditchweed.
This absolutely for sure. And then I used to import in a lot of weed from Canada. And we'd get the BC weed or the beasters. We used to sell a lot of the beasters all over. I moved to Eugene, Oregon specifically to get access to Canadian weed to ship back down south.
Oh, that's crazy.
Yes.
And wrapping up, what's one piece of advice that you give operators today who want to build a business that could eventually be acquired?
Systems. Day one, systemize everything you're doing. It's going to make you very attractive to an acquisition. All your processes, all your documentation. The DEA now is in your freaking back pocket. They're forcing you to do this stuff. So now you don't have a choice anymore. So get your act together, get your processes and systems in place, know your cost of goods, know your cost per gram, know your labor costs, know your metrics of your business. And by knowing that stuff, you'll run it better, smarter, and have a better opportunity to sell it.
It has been wonderful to have you on. I'm excited that I finally got you on. So thanks for your
Thank you.
patience.
Thank you. No, this is
Yeah,
great. I
then
appreciate it.
I think this is a great topic. It's going to be interesting for people who've been thinking about this, for listeners. And I'll have Ellis's information posted in the description box, and you'll be able to click on the link and get to his website. And for those who stream the podcast, it is available on Apple and Spotify or wherever you like to listen. And if you like video podcasts, check out my YouTube channel, which is at Under the Microscope with Jenny, and check it out and subscribe. Thanks again, Ellis. I really appreciate having you on. This was a lot of fun. It's always fun to have my colleagues. We talk a lot every week.
Me too.
Between
Yeah.
between Alex Herding, who I have on here, and we definitely all talk a lot every week. I appreciate you coming on, and thanks to my listeners, and we'll see you next week on the next episode.
Thanks, Jenny. Thanks, everybody. Have a great day.
Thank you.